Over the past few years, REIT share prices have crashed even as their cash flows kept on growing, and as a result, their valuations are today the lowest since the Great Financial Crisis. And how did they perform following the Great Financial Crisis? Well, they nearly tripled in value in just a few years. These massive results were the results of the low valuations. As the market finally realized that it had overreacted, REITs strongly recovered, leading to massive gains for those who had the courage to buy them when they were discounted. And I think that REITs are today presenting a similar once-in-a-decade opportunity to win big in the coming years as REITs finally recover from their 3-year-long bear market, and I think that some individual REITs could even double in the coming few years. And these are not just empty words, as I'm investing about 50% of my personal portfolio in REITs at the moment. Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and today's video I'm going to highlight 2 once-in-a-decade REIT buying opportunities. But before I get into it, can you please show your appreciation by clicking the like button, subscribing to the channel? That helps me a lot to keep on creating this free content for you on this YouTube channel. Thank you so much in advance. So the first REIT I'm going to discuss is one that you've likely never heard of, or maybe you have previously on this channel, but it's not a very popular REIT. It's called Vesta REIT, ticker symbol VTMX. This is my only Mexican REIT investment at the moment, and the company just recently held its annual shareholder meeting and it guided to grow its FFO per share by 10% per year on average for the next 5 years. They are confident in these rapid growth prospects because they greatly benefit from the growing trend of nearshoring, which is resulting in rapidly growing demand for industrial space in Mexico. This then allows them to hike rents and also keep developing new properties. Vesta REIT is today the only Mexican REIT with a US listing, and this provides them a competitive advantage by being able to access capital in the US at a lower cost, which then results in larger investment spreads once they put it to work in Mexico. Historically, they've been able to develop new properties with initial yields in excess of 10%, but their own cost of capital is much lower than that. Best of all, their balance sheet is today historically strong with a very low 22% loan to value, allowing them to add more debt on their balance sheet in the coming years as they build more properties, resulting in significant spreads over their cost of capital. But despite having such strong long-term growth prospects, the company is today priced at just about 12 times FFO, which is more typical of a REIT with stagnating or even declining cash flows. In fact, I think that this is the lowest multiple of any REIT that I know that's growing its FFO per share at over 10% per year and has so little leverage. Typically, such REITs trade at least double of that with multiples of 25 to 35 times on average. So why is it so cheap? Well, firstly, all REITs are out of favor, of course, and so all of them are today discounted. It's not just Vesta, but we think that Vesta is even more heavily discounted than the rest because Trump's recent victory has fueled the sell-off in Mexican REITs. The market fears that Trump's victory in the US could lead to significant tariffs, which could then derail the growth story coming from nearshoring. But this makes little sense to me. I think that his tariff threats are likely just a negotiating strategy, but even if they aren't and Trump's decided to put some tariffs on Mexico, I also think that it's likely to put even larger tariffs on China, which would then favor Mexico for nearshoring. Sophisticated players know this, and this explains why they continue to heavily invest in Mexico. As an example, Foxconn just announced recently that it's going to build the world's largest NVIDIA chip plant in Mexico, and Prologis recently also acquired one of Vesta's competitors in Mexico. In case you're not familiar with Prologis, it's the biggest industrial real estate investment firm in the world, and so it just recently bought one of Vesta's peers at a higher valuation than what Vesta is currently trading at. Blackstone, which is the biggest private equity real estate firm in the world, was also bidding on that same deal, and so clearly these sophisticated players are not too worried about the long-term prospects. I would also remind you that Mexican REITs sold off in 2016 in a similar fashion when Trump first won the election, but they then quickly recovered once it became clear that it wouldn't cause any major impact. I don't think that this time will be different. We'll have a lot of uncertainty and volatility in the near term, but ultimately both countries benefit from each other through trade very significantly. And besides, also, let's not forget that there is not just the United States in the world. Mexico is also benefiting from the growing trend of nearshoring with companies from Canada, but also Europe. Today, it's far cheaper to produce in Mexico than in China, even for European companies. And the transportation times to get your goods from Mexico is also a lot faster than from China. And so it's not just the US, but in any case, we'll have a lot of uncertainty in the near term, a lot of volatility, but ultimately I think that this is mostly politics, and I don't think that it will significantly impact the long-term fundamentals of Vesta REIT. And if I'm correct and the company keeps growing its FFO per share by 10% annually over the next 5 years, as the company just recently guided for, all while paying a 3% dividend yield, and we see an expansion in its FFO multiple from just 12 times today to, let's say, 18 times, which is still, very conservative, that will lead to a doubling or near tripling of the share price from today's level. I actually think that those assumptions are quite reasonable, and this is why I'm heavily investing in the company. Just last year, the same company trading for about 25 times FFO because everybody was focusing on the growing trend of nearshoring. The narrative has now changed, but it will change again. And once investors again want to pile into this nearshoring trend and see Vesta as a risk mitigated way to benefit from this trend, I think that we'll see significant FFO multiple expansion, which could lead to significant upside. Now the second company I'm going to discuss is called Patria Investments, ticker symbol PAX. This actually isn't officially structured as a REIT, but it is what I like to call a REIT adjacent business. Patria is the Blackstone of Latin America. It owns the biggest REIT asset management business in the region. It manages over 20 different REITs in Brazil, and it's now set to replicate the same business model in Colombia, Chile, and Mexico. As a result, they expect to double the size of their REIT asset management business over the next 3 years alone. Moreover, they also manage other alternative investments like private equity, infrastructure, credit, and those funds are today attracting a lot of capital. Overall, they expect to roughly double their fee-earning asset under management over the next 3 years, and this should result in 15% annual growth in their fee-related earnings per share. And again, despite growing at such a rapid pace, the stock is today heavily discounted. It has only gone lower and lower ever since it went public in 2021, and that's despite hitting or even surpassing all of their targets that they set at their IPO. And as a result, they're today trading at just 8 to 9 times their fee-related earnings, adjusted for its unrealized accrued performance fees. That's less than half of what other major asset managers like KKR, Blackstone, Brookfield, Blue Owl, and so on are today trading at. And so what's the catch here? And I cannot really find one. The company has one of the lowest leverage in its peer group, one of the best track record, one of the best growth prospects. The only things that seems to worry investors here is that they focus on Latin America, which is admittedly a riskier region of the world. However, it's also a faster growing region with ample opportunities for asset managers. They are the leader here, and there are increasingly many investors who are now looking to invest in this region to diversify their portfolio. And it's also important to note that Patria earns most of its revenue from hard currencies like the US dollar, the British pound, euro, and so on. And it's also well diversified by country in Latin America, by asset type, by strategy, and all of these significantly mitigate risks. Most of its funds also have very long terms. They are working with some of the world's leading institutional investors on a long-term basis. And so this is resulting in very sticky and predictable fee income. Finally, they've been investing in this region of the world for decades now. They have an amazing track record, even through different political administrations. And this is why other institutional investors want to partner with Patria, because they have such a great track record in this region of the world. And so I think that when you take all of this into account, Patria is essentially a risk-mitigated way of participating in the growth of Latin America. And so my base case scenario here is that the company will keep growing by 15% per year going forward, all while paying a 5% dividend yield. You add those two together, you're already getting 20% average annual total returns. But I think it will be far better than this, because I also expect some buybacks. They've recently initiated a new buyback plan, and I think that they will start more aggressively buying back shares once they are done deleveraging later this year. And at the same time, I also expect their earnings multiple, their free cash flow multiple to expand quite a bit. And even getting halfway to that of their close peers would result in an immediate upside of 50% from here. You add the growth, I think that over the next 3 years, you could see a doubling of your money investing in Patria Investment. But they have risks, of course, as well. You don't get to potentially double your money in just a few years without taking any risks. But the nice thing today is that there are so many such opportunities in the REIT sector that you get to build a diversified portfolio of undervalued REITs to mitigate risks and optimize your risk to reward. Some of them won't work out as intended, and I've had my fair share of losses over the years, but some of them will also work out even better than expected. But on average, I would expect very strong returns in the coming years. As I noted earlier, the last time REITs were so cheap, they tripled in the following years as they recovered from their bear market. I doubt that they will triple this time around because there is far less leverage in the REIT sector, but there are a number of individual REITs like those that we highlighted today that could double within a few years from now. At the moment, we hold about 20 REITs in our portfolio at High Yield Landlord, and if you want to access this full portfolio, you can join us for a 2-week free trial. I'll put a link to it in the description of this video. This will give you immediate access to my personal REIT portfolio, which is a real money portfolio. I share everything, every single dollar amount with our members there. You'll also get access to my transactions in real time, my exclusive research, REIT CEO interviews, a course to REIT investing, and much more. Again, completely free for 14 days. You can sign up. You can look into it for 10 days. If it's not for you, you cancel. You won't be charged a penny. If you see value in it and you decide to follow our strategy and want to stick with us for the long run, you also get a special discount for joining today. Thank you very much for your interest. Let me know if you have any questions in the comment section below. Once more, if you could please click the like button, that will help me a lot. Thank you very much, and see you at my next one. Bye-bye.